Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at advanced micro devices.
If you find our talks useful, please consider subscribe, like, and comment underneath. Imagine, handing the world's biggest tech companies the absolute right to buy 160 million shares of your stock for a single penny.
Which sounds completely crazy.
Right. On the surface, giving away equity for basically $0 sounds like financial malpractice. It sounds like a terrible idea.
Yeah, it really does.
But when you look closely at the actual mechanics behind it, you realize it might be one of the most brilliant strategic maneuvers ever executed in the data center wars.
Yeah.
So today, we're looking at how a company that was long dismissed as just the discount alternative has fundamentally rewired the whole tech hierarchy. They've basically become this indispensable infrastructure powerhouse.
And that transition from being just a backup option to an absolute structural imperative, that is exactly what the market is grappling with right now. If you look at the fundamental financial reality of advanced micro devices today, it is not being driven by some temporary market hype,
Right. This isn't just a meme stock rally.
Exactly. It is being driven by a tectonic shift in how global data centers are physically being built. We can see this immediately when we look at their full year 2025 results.
The numbers are just staggering.
They really are. They reported record revenue of $34.6 billion. That represents a 34% year-over-year increase.
$34 billion. That's a massive lead.
It is, but the top line number only tells half the story here. The metric that reveals the true underlying velocity, the really important part, is the data center segment.
Oh, absolutely, because that segment alone grew a staggering 172% year over year. It hit $16.6 billion.
Which is just a totally different stratosphere for them.
And if you isolate just the fourth quarter of 2025, they pulled in $5.4 billion in data center revenue in a single 3-month window.
Yeah, to put that into context for you, generating over $5 billion in a single quarter from data center infrastructure, well, that's a level of volume that used to take them multiple years to achieve.
Years, yeah.
And that acceleration is what pulled their net income up nearly threefold to $4.3 billion.
Wow.
We are seeing, essentially, a textbook demonstration of operating leverage. You see, in physical semiconductor manufacturing, your initial fixed costs are just astronomical.
Right, the fabs.
Exactly. You have to fund years of research and development, design the complex architecture, and set up the fabrication processes long before a single chip is even sold.
Yeah.
But once you cross a certain volume threshold, the economics completely flip.
It reminds me of the mechanics of launching a heavy rocket.
Oh, how so?
Well, the most energy-intensive, brutal part of the journey is just fighting through the gravity and the friction of the lower atmosphere, right? All those massive fixed costs. You mentioned the R&D, the fab setups. That's the atmospheric drag.
Right, the heavy lift.
Exactly. But once they break through and hit the vacuum of space, which is this new $16 billion data center run rate, there is basically no more friction.
Yeah.
Every additional thrust, every new AI chip sold translates almost entirely into pure velocity and bottom line profit.
That is a great way to look at it. And you see that lack of friction showing up immediately in their profit margins. Non-GAAP gross margins hit 52% in 2025.
52%. That's huge for hardware.
It is. And management is actually guiding toward 55% for the first half of 2026. And this isn't happening by accident, right? It is the result of a highly intentional mix shift.
Moving away from the cheap stuff.
Exactly. They are actively pivoting away from lower margin consumer electronics and dedicating their whole supply chain to these incredibly high margin AI accelerators. It completely transforms their financial profile.
Yeah, they're sitting on a ton of cash now.
Over $6 billion in cash and equivalents. And for an investor, that $6 billion isn't just a safety net. It is strategic ammunition.
Right, for buyouts and R&D.
Yes, it allows them to make non-dilutive acquisitions to bolster their technology stack. Contrast this robust free cash flow generation with legacy competitors like Intel, who are currently grappling with negative margins and massive turnaround costs.
It's night and day.
You basically see two companies heading in completely different financial directions.
So the financial engine is clearly roaring. But I guess that brings us to the underlying catalyst. High revenue is phenomenal, but why are the hyperscalers, the massive cloud providers that run the global internet, why are they suddenly pouring billions of dollars into this specific company?
That is the big question.
To understand that, we have to look at the structural moats being built, starting with a massive evolution in artificial intelligence itself. We are moving away from the era of generative AI, and we are entering the era of agentic AI.
Yeah, and this is a crucial distinction for anyone tracking technology infrastructure investments right now.
Totally different beasts.
Right. Generative AI is essentially what we have seen over the last few years. You give a system a prompt, and it generates text or an image based on pattern recognition.
Like writing a poem or making a picture of a cat.
Exactly. It's an impressive parlor trick, but it's relatively contained. Agentic AI is fundamentally different. These are systems designed to act as autonomous agents.
Why?
They don't just answer a single prompt. They are given an overarching goal. And to achieve that goal, they have to autonomously break down complex problems into steps, orchestrate different tasks, interact with outside software environments, and then verify their own work.
And doing all that requires a totally different kind of computing architecture, doesn't it?
Completely different.
Like you can't just throw raw graphics processing power at it anymore. You need incredibly powerful central processing units, CPUs, to manage that complex sequential logic and the orchestration.
And that is the exact hardware moat Advanced Micro Devices has successfully built. In the fourth quarter of 2025, their EPYC servo processor line captured a record 31.3% of the server CPU revenue share.
Wait, 41%? That's almost half the market revenue.
It's massive, and 28.8% of the overall unit share. They aren't just selling high volumes. They are winning the premium high core count sockets that these really demanding agentic AI workloads absolutely require to function.
And when you look over at the AI GPU space, the specialized chips doing the heavy mathematical lifting, specifically their Instinct line with the MI300X and the MI350, they've managed to establish a structurally guaranteed market floor.
Yes, the diversification play.
Exactly. The massive hyperscalers simply cannot afford the existential risk of relying entirely on a single dominant supplier for their most critical infrastructure. If that single supplier decides to raise prices 40% or they suffer some kind of supply chain shock, the hyperscaler's entire business model is threatened.
It's a huge vulnerability.
So that desperation to diversify creates a permanent, massive baseline of demand for a highly capable alternative.
It does.
But, I hear you on the hardware side, but I look at this and I still see a massive software wall. I mean, hasn't the primary competitor's software ecosystem, CUDA, been this impenetrable fortress for like 15 years?
It absolutely has.
Developers spent over a decade learning that specific proprietary language. All the legacy code is written in it. If a customer buys hardware from Advanced Micro Devices, how do they actually get their developers to abandon years of workflow just to switch over?
Well, that has historically been the single most potent bear argument against them. But the software landscape is shifting beneath our feet in a way that rapidly erodes those historical developer switching costs.
Oh, really? How so?
Advanced Micro Devices has heavily invested in their open source software platform called ROCm 7.0. The breakthrough here isn't that they built a better proprietary language to compete with that 15-year fortress.
Okay.
It's that ROCm 7.0 is now fully and seamlessly compatible with major high-level AI frameworks like PyTorch and TensorFlow.
Oh, wow. So the developer doesn't actually have to code all the way down at the middle layer anymore.
Exactly. That's the real shift in the developer workflow. Today's AI engineers aren't writing low-level hardware-specific code the way they did 10 years ago.
Right.
They are building complex neural network models at a much higher level in frameworks like PyTorch. So as long as PyTorch translates smoothly to the hardware underneath, the human developer does not care whose logo is stamped on the physical silicon inside the server rack.
That makes total sense.
Yeah, ROCm 7.0 effectively acts as a universal translator. By perfectly supporting these open source frameworks, it bypasses that 15-year proprietary software fortress entirely.
That is wild. So if the software mode is finally deepening to match the hardware mode, who is actually willing to bet their infrastructure on it?
Yeah.
I mean, we're seeing exactly who when we look at the stock's massive momentum.
The market is certainly paying attention.
Oh, absolutely. It's trading up near the $245 level, breaking into entirely uncharted territory, especially when you consider that in early 2025, it suffered an $80 valuation reset.
Yeah, that was a tough reset. But a recovery and sustained rally of that magnitude suggests a massive shift in institutional confidence.
The smart money is moving.
Exactly. If you track the capital flows, major hedge funds were aggressively accumulating the stock in the first quarter of 2026. Their underlying investment thesis centers heavily on the concept of scarcity value.
Scarcity of the top-tier chips.
Right. Right now, the global demand for high-end AI silicon vastly outstrips what the global supply chain can physically manufacture. So, in a severely supply-constrained environment like this, any company capable of producing top-tier, reliable AI accelerators possesses immense compounding value.
But the institutional buying is just the warm-up act, really. The real fundamental drivers are the corporate mega deals.
The hyperscaler deals.
Exactly. We are talking about a massive multi-year agreement with Meta for up to 6 gigawatts of Instinct GPUs.
Which is an unimaginable scale.
Right. Now, when we talk about gigawatts in the context of data centers, we are talking about city-size energy footprints. This deal alone is potentially worth $60 billion.
Yeah.
And OpenAI locked in a similar 6-gigawatt agreement back in October 2025.
Just to give you a sense of scale on that, a standard nuclear power reactor typically generates about 1 gigawatt of electricity.
1 gigawatt.
Wow. So when we say Meta and OpenAI are securing 6 gigawatts of capacity, they are securing the equivalent of 6 nuclear power plants worth of energy consumption solely to run these specific processors.
That is just mind-blowing.
It is. Deals of this magnitude provide something extremely rare in the semiconductor industry, and that's profound visibility.
Right, seeing into the future.
Exactly. It secures a multi-year revenue pipeline that allows investors to project cash flows with a much higher degree of certainty.
And this brings us back to those one-penny share warrants I mentioned at the top of the show.
Yeah, the warrants.
The mechanics of these gigawatt deals are where the sheer brilliance shines through. Both the Meta and OpenAI agreements include 160 million share warrants at an exercise price of 1 single penny.
Basically free stock.
Right. Think about the psychology and the financial alignment of that structure.
Yeah.
This isn't a traditional vendor-client relationship anymore.
Not at all.
By giving these tech giants the right to acquire millions of shares for essentially $0, you are inextricably linking their balance sheets to your long-term equity performance.
It really is a masterclass in modern strategic partnership. I mean, if you are Meta or OpenAI and you hold millions of those penny warrants, you now have a direct, massive financial imperative to see advanced micro devices succeed.
You want their stock to go to the moon.
Absolutely. You are going to ensure your software engineers optimize perfectly for their hardware. You are going to share your long-term technological roadmap with their chip designers.
Yeah.
You are actively invested in making sure they thrive because your own corporate treasury benefits astronomically from their stock price going up. It transforms your biggest customers into deeply invested structural partners at the absolute highest levels of the tech ecosystem.
That structural alignment is incredibly bullish. I mean, it's genius. But to be thoroughly well-informed here, we do have to look at the other side of the ledger. You know, what are the macro and competitive risks staring down this thesis?
We have to look at the dominant player.
Right. Let's look at the primary competitor. Oppenheimer recently put out a research note arguing that the competitor's upcoming Blackwell architecture keeps advanced micro devices perpetually a step behind.
It's a valid concern.
We are talking about a dominant player that still holds over an 80% market share and commands 71.1% gross margins.
And those 71% gross margins are an incredible competitive weapon.
How so?
Well, when you control 80% of the market and capture 71 cents of gross profit on every single dollar of revenue, you generate a tidal wave of cash.
Yeah, it's just a money printer.
And that cash allows for a relentless, massive reinvestment cycle into new research and development. It is exceedingly difficult for a company currently operating at 52% margins, even a highly successful one, to match that sheer volume of R&D spending dollar for dollar.
Right. It forces them to be incredibly efficient and highly targeted with their engineering resources.
We also need to factor in the broader geopolitical and macroeconomic realities. There is the overarching context of the Iran war, which is introducing significant volatility into global macro conditions and supply chains.
Definitely creating noise in the market.
And more directly impacting the balance sheet, we have the China export controls. Advanced Micro Devices actually took a painful $440 million charge in 2025, specifically because they were blocked from selling their specialized MI308 chips into the Chinese market.
That was a tough pill to swallow.
Yeah, taking a nearly $500 million hit to the total addressable market seems like a massive red flag for their future growth trajectory, right? I mean, how do they navigate around a permanently closed market of that size.
Well, you are absolutely right to highlight it. Any government restriction on a company's total addressable market is a severe headwind, and $440 million is a tangible, immediate loss of revenue.
Yeah. However, the market is forward-looking, and it is assessing how that specific geographic risk is being mitigated by domestic expansion. This connects directly back to those 6-gigawatt mega deals with Meta and OpenAI.
Oh, I see where you're going.
Yeah, the massive, unprecedented pivot toward localized, U.S.-based hyperscaler deployments creates a localized revenue floor that effectively absorbs and offsets the lost Chinese demand.
So while losing the overseas market hurts on paper, the domestic data center build-out is just so ravenous that it consumes whatever capacity was freed up by the export blocks.
That is the exact dynamic playing out right now.
Yeah.
And to put it into the broader industry context, the overall AI infrastructure market is projected to expand to over $300 billion by 2030.
$300 billion.
Right. In a total addressable market expanding at that velocity, advanced micro devices does not need to completely overthrow the primary competitor.
They don't need to be number one.
No, they do not need to capture 60% market share to generate massive wealth for their investors. They simply need to maintain their newly cemented status as the indispensable, highly capable second source.
Yeah.
By securing just 20 to 30% of a $300 billion pie, they can mathematically double or even triple their data center revenue over the next few years without ever having to dethrone the market leader.
That makes a lot of sense. So, having weighed that staggering momentum against the geopolitical and competitive risks, let's map out the immediate timeline for you. What actionable events should you be watching over the next 3 to 18 months?
The calendar is packed.
Up first on the Catalyst calendar, we have the May 6, 2026 earnings report. This is the crucial Q1 2026 update, and analysts are just laser focused on it.
They're very focused.
Said he recently placed an upside 30-day Catalyst watch on the stock leading into this specific date. The market is expecting management to finally quantify the early, tangible financial impact of that massive Meta partnership.
And alongside the company-specific earnings, investors really must monitor the macroeconomic tailwinds, specifically the April 29 FOMC decision.
Right, the Fed.
Exactly. Regardless of one's stance on the specific geopolitical developments, the recent easing of tensions in the Middle East has tangible macroeconomic ripple effects. It significantly reduces global uncertainty.
Which the market loves.
Right. And when you combine that reduction in geopolitical risk with a less hawkish stance from the Federal Reserve, you see a compression in discount rates.
Right.
The financial math here is straightforward. When discount rates drop, the present value of future cash flows increases. This causes capital to rapidly flow back into high-growth, high-beta assets like mega-cap tech stocks, providing a powerful macro tailwind for their valuation.
But the technological milestone everyone is really waiting for in the second half of 2026 is the launch of the MI450 Helios rack scale system.
Oh, absolutely.
The specifications on this system are wild, particularly the inclusion of 31 terabytes of HBM4 memory. That actually exceeds the primary competitor's flagship NVL144 system when it comes to raw memory capacity.
And for anyone analyzing these systems, understanding HBM4, which stands for high bandwidth memory, is critical.
Yeah, explain that.
Well, right now, raw computational speed is no longer the primary bottleneck in AI development. The bottleneck is memory capacity.
Interesting.
Doesn't matter how fast the processor can crunch numbers if it doesn't have enough data immediately available to work with. The processor ends up just sitting idle, waiting for data to be transferred.
You know what this reminds me of? It's like giving an artificial intelligence a massive short-term working memory upgrade.
Yeah, exactly.
Imagine you have this incredibly brilliant worker that's your processor, but they have a tiny cluttered desk that's the older generation memory.
Right.
To do complex work, they constantly have to get up, walk over to the filing cabinet, grab new documents, and sit back down. That travel time wastes all their brilliance.
That's a perfect analogy.
The 31 terabytes of HBM4 in the MI450 is like giving that brilliant worker an acre-sized desk. They can lay out millions of documents, millions of data parameters all at once. They never have to get up.
And that massive desk space is perfectly tailored for the complex, multi-step orchestration required by emerging agentic AI.
Right.
The AI agent doesn't just calculate one math problem, it holds entire contextual universes in its memory while it actively solves complex problems in real time.
Yeah, that makes sense.
And that is exactly why memory bandwidth dictates performance and why this specific technological leap is drawing so much institutional attention. I mean, analysts like Erste Group recently upgraded the stock from hold to buy specifically because of this roadmap.
Yeah.
So if we synthesize all the data points, the fundamentals, and the upcoming catalysts into a final thesis, the outlook is remarkably strong. We are looking at an 8 out of 10 bullish score, mapping out an 18 to 24-month target horizon. The core takeaway for your portfolio is this. They have permanently shed the historical label of the discount alternative. They are now the indispensable infrastructure partner for the AI supercycle.
They really are.
Between the $60 billion Meta partnership, the surging CPU market share driving agentic AI, and the upcoming MI450 launch, which is projected to potentially double their data center revenue by 2026, they offer a very rare investment profile.
Yep.
They possess a proven, entrenched technological moat and a hyper-growth trajectory, all while trading at a fraction of their primary competitors' overall market capitalization.
It is a remarkable evolution from where they were just a few years ago. But before we wrap up today, I want to leave you with one final provocative thought to mull over. As we've discussed today, the accepted Wall Street narrative is that they are the essential, highly profitable second source, trailing slightly behind the leader's performance, but growing massively nonetheless.
Now, that's the baseline expectation.
But right now, there is unconfirmed chatter. Serious, sustained market rumors that advanced micro devices might actually beat its main rival to the 2-nanometer node for high-volume GPU shipments.
Which would be unprecedented.
Moving to a 2-nanometer physical transistor size represents a massive leap in power efficiency and raw computational density. If that rumor proves true, if the indispensable second source actually beats the dominant 80% market share player to the next physical generation of silicon, will Wall Street have to completely rewrite the global tech hierarchy?